crude was slightly jolted after plans for Vice President J.D. Vance to begin talks with Iranian representatives were suspended. Reports gave no reason for the delay, though overnight Israeli strikes in southern Lebanon may have been a factor. Prices inched further down as reports later said Israel and Lebanon had agreed to a ceasefire starting today, Friday. This was as more oil tankers were said to be moving through the Strait of Hormuz. The MOU, earlier signed by Donald Trump, President of the United States, and Masoud Pezeshkian, President of Iran, has allowed both sides to claim victory as negotiations progress towards a more permanent pact. While there are obstacles before a lasting agreement, markets were relieved that some sort of truce has been achieved as the 60-day deal starts on shaky ground at best. Though Iran has confirmed that the Strait of Hormuz is open and the US said it has ended its own naval blockade, the contention is by no means over. Reports that Iran still wants to introduce a maritime fee for ships after the negotiating period has not helped getting the accord to a strong start. Trump is opposed to any toll for ships using the Hormuz waterway. Analysts say the uncertainty baked into the MOU and challenges with Israel set a firm floor on dropping prices. Market analysts, however, updated their forecast for 2026, saying lower oil prices for Brent standard range bound between $75 and $85 a barrel in the near term. The wide range and volatility reflects a refocusing on timing and volume of resumption in oil shipping and if insurance rates and other logistics-related costs will remain elevated. This means caution in coming to any conclusion on the pace of price normalization. Meanwhile, Middle Eastern players, including UAE, are accelerating alternative pipeline construction to bypass as much as possible the Strait of Hormuz, which reduces the power of Iran in controlling oil flows from the region. We also see major importers like India building additional inventory storage to improve their energy security. The India state-owned Oil and Natural Gas Corporation is building $1.6 billion of storage infrastructure to expand strategic petroleum reserves to boost energy security. India's underground strategic petroleum reserve storage currently has a total capacity of 5.33 million metric tons of crude, equal to 39 million barrels of crude oil, or just 8 days' worth of consumption. Additional infrastructure at Mangaluru will take capacity up to over 7 million metric tons, raising storage capacity by a third. Other major importers like China are doing the same. Amid the drama, OPEC released its latest World Oil Outlook 2026 report this week. The outlook is built on the view that billions of people outside the OECD countries will continue to seek cars, air conditioning, air travel, consumer goods, and reliable electricity. Solid growth in Africa and other emerging and developing economies also expected to support strong energy demand. India alone is projected to add over 8 million barrels per day of oil demand by 2050, while Africa, the Middle East, Latin America, and developing Asia are expected to account for much of the remaining growth. OPEC forecasts global oil demand to rise from 105.1 million barrels per day in 2025 to 113.3 million by 2030 and to exceed 124 million by 2050. In a recent interview, OPEC Secretary General Haitham Al-Ghais said the report challenges the thinking that oil demand will peak in the foreseeable future. He also rejected earlier forecasts from the International Energy Agency that point to a near-term supply glut. Meanwhile, electric vehicle sales continue to dominate headlines. Governments remain committed to net zero targets, and energy transition advocates take a different view. OPEC argues that fossil fuels will retain their share of the energy mix, while coal-based energy will fall sharply and renewables will grow the fastest. Oil demand is expected to peak only in richer countries as electric vehicle adoption accelerates in Europe, California, and China.
OPEC's World Oil Outlook 2026 provides a realistic view of the likely evolution of the energy landscape to 2050. In spite of a multitude of uncertainties, OPEC's perspective offers a clear path to navigate an evolving energy industry. This serves as an important platform, facilitating international cooperation and knowledge sharing to ensure global energy security. Looking ahead, the global population is set to increase by over 1.4 billion people to 9.7 billion by 2050, and the urban population by 1.7 billion, largely in developing regions. The global economy is set to double by 2050. As a result, and despite efficiency gains, overall primary energy demand is set to rise by 23%. Growth is seen in all energy sources except for coal and is concentrated in non-OECD countries. While demand for renewable energy is expected to record the strongest growth, oil retains its dominant 30% share in the global energy mix through to 2050. Demand for electricity is set to rise by around 85%, primarily due to strong growth in developing countries in Asia. This demand spike is driven by economic development, electrification across all sectors, and supported by the spread of AI and data centers. Global oil demand remains robust and is set to expand by 19 million barrels per day by 2050 to reach over 124 million barrels per day. There is no peak demand on the horizon. The primary drivers for this long-term demand growth are non-OECD countries, where demand increases by 27 million barrels per day, primarily in India, other Asia, the Middle East, Africa, and Latin America, while OECD demand declines by almost 8 million barrels per day. This growth is fueled by road transportation, aviation, and petrochemicals. Road transportation demand growth comes on the back of a large expansion in the global vehicle fleet, from 1.7 billion in 2025 to nearly 3 billion in 2050, most of which is in developing countries. The fastest growth is seen in the segment of electric vehicles, but internal combustion engine vehicles continue to dominate the global fleet, accounting for around 73% of the total in 2050. On the supply side, with U.S. liquid supply peaking in the early 2030s, total non-DOC liquids are expected to plateau around 60 million barrels per day from the mid-2030s. Consequently, the relative role of DOC liquid supply is expected to increase significantly, with an expansion to 64.5 million barrels per day. The downstream sector, the Asia-Pacific, Africa, and the Middle East lead long-term refinery capacity growth. In total, global distillation capacity additions to 2050 are projected at 19.3 million barrels per day. Secondary capacity additions over the same period are also significant. With demand continuing to grow and existing resources naturally declining, almost $18 trillion will need to be invested in oil by 2050. Two alternative scenarios to the reference case: the technology-driven scenario and the equitable growth scenario shed light on the range of uncertainties ahead. OPEC's World Oil Outlook 2026 aims to encourage meaningful discussion by offering a neutral, evidence-based, and trustworthy perspective on our global energy future. It envisions a future in which energy is accessible, affordable, and sustainable. One that helps drive prosperity for countries and populations across the world.
Hello and welcome to Global Business Insights, where we bring perspectives to help you understand an increasingly complex terrain. In other news, the US-Iran Memorandum of Understanding has eased immediate risks, bringing some relief to markets. Against that backdrop, the Bank of England left interest rates unchanged yesterday, describing the decision as an active hold. The BOE kept rates at 3.75% and lowered its inflation forecast, while warning that uncertainty linked to the Middle East conflict remains. The decision is being read as a tightening signal since markets had expected rate cuts before the conflict in Iran. Meanwhile, the European Central Bank raised interest rates at its own latest meeting, the first G7 apex bank to do so. Governor Andrew Bailey said high energy bills will continue to pressure households, with the off-gem price cap rising from July. However, the BOE now expects inflation to peak slightly above 3.25% toward the end of the year, below previous best-case forecast of 3.6%. That was the previous forecast for inflation. In the UK, the pound sterling remains pressured by politics and tepid growth outlook. The pound to dollar risks are skewed to the downside, reflecting the stronger US growth outlook relative to the UK and the murky UK political backdrop. On the politics, Andy Burnham won the Makerfield by-election, clearing a path for his return to Parliament and a leadership challenge to Prime Minister Keir Starmer. And in Africa, Kenya and the United States are reported to be close to agreeing a critical minerals deal that would require strategic resources to be processed locally as African governments push to capture more value from their natural wealth. As global demand for critical minerals rises, governments across the continent are increasingly tying resources access to local processing, manufacturing, and job creation rather than exporting raw materials. But President Ruto at the G7 is also expected to have advanced the many other causes of the continent. At the Africa Forward Summit in Nairobi, African leaders called for a reassessment of how risk is priced, how private capital can be mobilized, and how African countries can gain access to cheaper, longer-term development finance. The obvious challenge for Ruto is that the G7 remains a club of the world's most advanced economies. But though they listen, they often move more slowly when it comes to issues confronting developing nations. Global markets were mixed today, with Asia-Pacific exchanges mostly closing lower as investors weighed the implications of the U.S. brokered peace agreement with Iran. U.S. markets were closed for the holiday. Also, attention may now begin to shift away from months of AI-driven headlines and toward the strength of U.S. economic growth, the path of inflation, and questions around Federal Reserve independence under Kevin Walsh as he announced task forces to begin a process of overhaul in Federal Reserve operations. Well, that's it on this special weekend episode of Global Business Insights. We are now on Spotify, Apple, YouTube podcasts, and most popular platforms where you get your podcasts from. Remember to select the notification button if you subscribe on YouTube. We do use artificial intelligence for generating hashtags, keywords, and for editorial purposes, but we do cross-check all our facts with primary sources as well. Thanks for watching. Bye-bye.